Welcome to the Knight Frank 2020 Africa Retail Report launch. It's great to have all of you here. And what can we say? It's been an incredibly difficult year in the retail sector. COVID has had its implications on us both personally and professionally. And I think we're all glad to see the end of this year, although I think we all know we've got some trials and tribulations coming up ahead of us in the early part of next year. I'm going to take this opportunity to introduce you to our panelists this morning and afternoon. These are the members that make up the Retail Council of Knight Frank Africa. We have with us Ashmi Shah from Kenya. We have Tim Ware from our Zambian office. We have Tope Dario from our Nigerian office. We have David Watson from our Botswana office, Patson Mantare from our Zimbabwe office, and Ahad Maskiri from our Tanzanian office. Obviously, my name is Mark Dutoy, and I'm from our Ugandan office. The way the proceedings are going to run this morning is we're going to hand over to Tilda Mwai. Tilda is based in our Middle Eastern office in Dubai. Tilda is our research analyst for Africa, and she is the lady of the moment today, who is going to give us the insights and what the research shows has happened across the continent. Thereafter, we will have a question and answer where you're welcome to pose questions to our panelists from the Retail Council, and that will be moderated by Mrs. Judy Rugasira Chanda from our Ugandan office. So welcome all, and let's get into the spirit of things. Over to you, Tilda.
Thank you, Mark. Just a minute as I share my screen. I hope you can all see my screen now. Good morning, ladies and gentlemen, or good afternoon. My name is Tilda Mwai. As Mark mentioned, I am the researcher for Knight Frank, and I am the researcher for Africa at Knight Frank, and it is an honor to engage with you all today. So over the next 20 minutes, I will attempt to provide our perspective on the formal retail landscape across Africa with the bias on shopping malls and how we expect the sector will shape up moving forward. Just a little bit about Knight Frank. We are the largest independent global real estate advisors, and our presence spans 512 offices across the world. And in Africa, we are based in 9 countries. Over the past 12 months, we have worked in 43 out of 54 countries, providing a range of services from advisory, transactional work to research work. For our agenda today, I will provide an overview in terms of on the retail market performance in the year to Q3 2020, the opportunity in Africa's retail, and more importantly, the influences that we expect will impact the Africa's retail sector moving forward. In terms of the retail market performance, I think it is undeniable that the retail sector has been one of the hardest hit sectors as a result of supply chain disruptions that we saw happening earlier on in the year, and government measures that were adopted to curb the spread of COVID-19. And lockdowns, for example, have represented an unprecedented shock for retailers, with non-essential services being shut down. So that has had quite an impact on the sector. So, however, when we look at Google's mobility data across different countries, it indicates that the retail sector has recorded a recovery towards the baseline, and in some instances, as you can see from the chart on your screens, that recovery has been recorded above the baseline. The disclaimer here, however, is that this recovery has been driven by sectors such as fast food restaurants, with non-food sectors anticipated to take longer to recover. And so as a result of the lower levels of demand that we have recorded in retail sales across the continent, we expect Oxford Economics has, according to Oxford Economics data, retail sales are expected to contract by 5% year on year in 2020. And in some instances where the economies were already considerably challenged pre-pandemic, such as Harare and Johannesburg, retail sales are expected to contract more sharply, with expected contractions of 31% and 12% respectively. So, however, if you narrow the forecast onto shopping centers, there are a few outliers, with some of the retailers recording relatively strong performance in the wake of the pandemic. Branded fashion retailers, for example, in Kampala and Nairobi, tripled their sales turnover since the onset of the pandemic. And this can be attributed to the ban on international travel, which effectively redirected demand to the local markets. As a result of this as a result of demand softening and as a result of the impact that we have seen so far on the pandemic, we estimate that prime retail rents across the continent will have declined by 6% on average in the 6 months to September 2020. If you look at some cities such as Harare, Lagos, and Luanda, those ones recorded the most notable prime rental declines of 50%, 40%, and 31% respectively. But if you look at other cities such as Kampala and Cairo, we noticed a relatively low rental growth in these markets, and this can be attributed to increased demand for prime space in these sectors. Despite this, we have seen occupancy rates remain stable across different markets. And despite even the planned exits that we have recorded happening across the continent in the different markets. But overall, we have seen that the occupancy rate was recorded at 80% as at Q3 2020 in the markets that we track. However, for markets such as Harare and Lilongwe, as you can see on my screen, this was a bit higher at occupancy rates of 95% and 90%, and this can be attributed to the limited supply of prime retail space. Overall, as we have seen, the transition to a mall culture in Africa continues to grow, and the offerings in malls will continue to be available in terms of meeting consumer needs. And so for us, in trying to understand Africa's formal retail opportunity, we have looked at 3 key influences that we have broken down in terms of sizing the market and the need for niche differentiation and the prospects for online retail. And so in order for us to size the market, we looked at formal retail penetration against average household income, against retail sales, and also factored in average household income. And in the 9 countries that we're physically located in, we estimate that shopping center space per capita is at 0.31 square meters on average, which is significantly lower if you compare that with other countries such as the US and cities like Dubai, where per capita retail space is 2.4 square meters and 1.2 square meters respectively. But Lagos, in our analysis, had the lowest shopping center space per capita at 0.01, with Gaborone recording the highest shopping center space per capita at 1.34. And so as we move on and moving forward, we anticipate that Africa's growing population and the rising middle class will underpin future demand for formal retail. But we also agree that there's a need to understand demand intricacies between different countries. For example, some cities like Harare are expected to see a decline in the number of middle-income households by 25% by 2025. And a city like Dar es Salaam, for example, the number of middle-income households are set to increase by 32%, according to Oxford Economics, by 2025. And so these are some of the aspects that we understand will continue to impact retail demand. I think the other thing that we focus on in terms of niche differentiation is that due to the localization of retail demand as a result of the pandemic, we have obviously seen convenience and neighborhood retail starting to increase levels of development activity and interest. And we anticipate that this trend will be underpinned by increased relocations of people and business from city centers towards the suburbs, in the new phenomena of working from home and people moving away from city centers. And as a result, we have recorded that neighborhood malls recorded a higher rebound in retail sales and footfall in Q3 2020 due to this increased demand. And this trend is expected to continue in the near term to long term. When it comes to online retail, there's no doubt that the pandemic has accelerated a change in consumer attitudes towards online retail. And this has resulted in online retail platforms growing across the continent. However, we can all agree that the narrative that the rise of online retail is expected to supplant physical retail is at best quite simplistic and at worst a bit more complex than that. And so what we anticipate is that online retail will not supplant physical retail, but it has made it more complex to operate. For example, if you look at the UK as an example, where we have where we can say that online retail is fairly developed at 19% on average. We have online retail sales as percentage of total retail sales at 19%. We find that 82% of retail sales occur in physical stores, 9.1% are in pure play online with retailers such as Amazon, and 8.9% online farms have physical stores. And so the online multi-channel sector has grown at around the same rate as pure play. And so the rise of online is something that has been a major opportunity, but one that requires significant capital investment. But we are seeing some people rise to the challenge finally. And so as a result, moving forward, we expect that the lines between the two will be blurred and become non-existent. And so going forward, we will see this play out as we expect the size of retail outlets to change and adapt to this multi-channel reality. But in certain sectors where last mile infrastructure is lacking, which is the situation in a majority of our cities, surplus retail will be repurposed into distribution hubs, and landlords must also drive footfall and add to the experience with instances such as pop-up stores. And so when you look at Africa in general, our online retail penetration remains low. Globally, as you have seen in my previous slide, online retail accounts for 16% of total retail sales, compared with just 1% in sub-Saharan Africa. And in countries such as Kenya, Nigeria, we also have online retail sales at 1%, and South Africa at 2%. So looking ahead and moving forward, while it is still too early to confirm the long-term impact of the pandemic, which we expect will become a bit more clear in the later months of this year, 2020, and early on next year. It is clear that the pandemic has accelerated pre-existing trends and prompted some new innovative thinking around the sector moving forward. And so we have highlighted 5 key themes that we believe will impact the sector moving forward. And so one of the themes that we expect will be a change in retail rent models with a bias towards turnover-based trends. And so since over the past few months, we have seen the sector shift in market balance to a tenant-favored market as landlords are bidding to attract and retain tenants. And so we expect that this will ultimately impact lease negotiations moving forward. And in a previous survey that we conducted earlier on in the year, our Knight Frank Africa Market Pulse survey, majority of the retailers that we questioned indicated that they were open to considering turnover-based rents, with only 10% opposing such a model. And so we expect that this trend will have a long-term influence on retail rent models across the continent. The other thing that we anticipate will impact the sector moving forward is the new age consumer. And this is largely attributed to Africa's population that is expected to continue rising, leading to a gradual shift in consumer spending patterns. And so we anticipate that the exposure to global brands and the desire to upscale lifestyle trends will influence the type of retail demand that we will see moving forward. And the increasing levels of market participation by internationally recognized retailers is likely to impact the tenant mix within shopping malls in the near to long-term future. The other trend that we anticipate will impact the retail sector moving forward is the leisure boom. And we are attributing this to Africa's youthful demographic that we anticipate will continue to grow, leading to increased demand for entertainment and cultural amenities such as cinemas, sports clubs, adventure parks. And while it is true that the entertainment sector has been among the most impacted sectors in retail by the pandemic, we expect that moving forward, it will make a turnaround to reflect this demand. And there's no doubt that the pandemic has accelerated the need for sustainable and flexible developments. And so we anticipate that there will be a design rethink by retail landlords moving forward and developers. And already retail developments such as Eastgate Center in Harare have set a benchmark for this. And going forward, retail development will therefore require an inclusion of suitable content of sustainable and flexible design elements such as green spaces, adaptability, and connectivity. So this is a trend that we anticipate will continue to be reflected across the continent moving forward. And finally, I think more importantly, it is important to note that the pandemic is not over yet. As of today, the number of COVID-19 cases across Africa were recorded at 2.2 million. And as you can see on my chart, this number is still rising. So several measures that we have seen adopted to curb the spread of the pandemic are likely to continue in the long term. And so, for example, we have seen that people are making less frequent and shorter shopping trips with a more focused approach and reduced window shopping in the new world, in the new normal. And so this is a factor that physical retailers must now invest in with omnichannel experience in order to attract and retain customers. In conclusion, I think while uncertainties abound, there's still opportunity for formal retail to thrive, and the sector will bounce back, but with new characteristics that are expected, such as the need for modern, fit-for-purpose retail floor space, and further the underlying market fundamentals of resilience, sustainability, connectivity, and flexibility are expected to be key to investor interest moving forward. And so this is expected to be the elements that will continue to impact the retail sector. And it is something that we expect will continue to shape up moving forward. And so thank you very much for your time. And If in case of any questions, my contacts are on the slides, and I'll now hand over to Judy to take us to the next session of our webinar today. Thank you so much.
Thank you very much, Tilda. That was an excellent and insightful presentation you just gave us, full of very useful information and evidence-backed data, which is always such a pleasure. Thank you. I have a few questions that I would like you all to shed some light on. The first one is to do with Zambia. I noticed a number of major South African retailers established in Zambia for many years left in 2020. Tim, is the depth of the local and regional market sufficient to replace them, in your opinion?
Thanks, Judy. Thanks so much for that question. You know, Zambia has historically had good interest and good establishment from retailers from South Africa. The ShopRite opened here in 1995, and they've now got 37 stores, and a number of other South African retailers followed them, such as Pep Stores, Hungry Lion, and generally their stores in some of the malls in Lusaka and elsewhere around the country compare in the top 3 around the region. So they're well established and they do very well here in Zambia. I mean, I think this year we saw Edgar's and we saw Jet leave Zambia, and we've seen some slowdown in stores expanding like Pep Stores and also Mr. Price. The market is changing. I think at the moment we've seen LC Waikiki come in. That's a clothing retailer from Turkey, and they've established themselves at the Manda Hill Shopping Center. But that's only one, and we need to see that overseas sector perhaps look more into Africa and see the opportunities here, just as Tilda was talking about in terms of our demographic. In Zambia, we're growing at 2.5% to 3% per annum. We're about a population of 18 million people. So we know that there is huge potential. The malls are well established. Retail here is quite mature. Manda Hill opened, which was the first mall in 1999. So we do have an established market. I think the smaller end of the market, the local retailer, is quite thin on the ground. We have 1 or 2 stores that are doing quite well. There's a store called Yashika that is open at Manda Hill and is actually looking, it's a local store, but it's actually looking to go elsewhere into Africa. So that's a good story. But I think we do need to look at ways in which we can grow our local retailer section more, perhaps with franchises, just as the South African retailers introduced franchise into Zambia, particularly with the fast food sector. So I think over the next couple of years, driven a little bit by what's happened this year, and a little bit of oversupply in our market in Zambia at the moment, we are seeing a change and a need to bring in new retailers from the region, groups coming in from perhaps East Africa to start with, and then maybe down further from the Middle East. We've seen Carrefour go into East Africa, the supermarket group, and open up there. LC Waikiki, I remember they came here about 3 or 4 years ago. So it took them that period of time to then open up this year, and we know that they're looking to expand as well. So I think with the changes that are happening, it is a sector that is adjusting. We do need to see it in Zambia in particular at the local and regional end. We need to see more retailers be encouraged, perhaps through government incentives and policies, to be able to trade and establish businesses. Thanks, Judy.
Excellent. Thank you very much, Tim. Just moving on to your neighbor, Zimbabwe. Patson, why is it that there are no foreign property investors targeting the retail sector in Zimbabwe?
Yeah, thank you, Judy.
Yeah.
Can I go on? Can I?
Yeah, please proceed.
Thank you very much. You know, investors tend to look fairly long term, and they look at the politics, they look at the economy, they look at the social factors. And if you look at Zimbabwe, all these factors. Hello? Hello? Hello,
Patson,
can you hear me?
You. We can hear you, Patson.
Yeah, I think I had lost you. So if you look at all these factors, they've been pretty bad for Zimbabwe for the last 2 or 3 decades. Um, Firstly, we have had local indigenous laws. Hello? Hello?
Patton, we can hear you.
Yeah, okay. We have had local indigenous laws that have been prohibiting foreign investors from coming into the country. And also, you know, there's been a lot of political rhetoric from our politicians, you know, and these tend to drive away investors, people who want to bring in their money. They want to take the money out. But if the environment is very uncertain, you find that there are very few foreign investors that come into the country. So we've been in a very unstable situation, and a lot of investors, particularly from South Africa, fly over Harare, fly over our country and go to places like Zambia, Malawi, Uganda, etc., because there is a lot of political risk. People don't know what will happen tomorrow if they pour their money. So we have suffered from that from that angle. As a result, the few shopping centers that are in Zimbabwe, the retail malls, are locally owned, and they don't go in line with the population. There's no relationship between the current shopping malls that are available and the size of our market. It is mainly because there is another leg that is missing from foreign investors. If the two were combining, i.e. the local investors and the foreign investors, maybe Zimbabwe will be a different story. But we remain optimistic. I mean, having said all that, we remain optimistic that things change. Maybe with the new political dispensation which we have, there will be more stability, and investors will be attracted to come into our country. Thank you.
Thank you very much for that, Patson. Just moving down south a little bit to Botswana, David, the report highlights a shift away from the regional malls to neighborhood centers. And clearly this follows the sentiment for the office sector accelerated by COVID this year. With many now working from home, or at least part of the time, how are these trends likely to impact the current CBD regional malls under construction, next to the Fields and other city center shopping centers in Gaborone?
Thanks for that, Judy. Morning, Judy and everyone. The proposed development in the CBD is listed to be about 28,000 square meters. So it's quite an ambitious project, but it's been long awaited as the only sort of designated retail center for the central business district, which follows on from also a multitude of new office builds. The proposed scheme, I would say, probably at the moment in time is rather ambitious. If you look at the size of it, a 28,000, that's a regional centre, and it's quite close to Rail Park Mall, which is a successful mall established sort of 5 years ago, which is about 32,000 square meters. That is obviously at the low end, close to the railway station, the taxi rank, and it does rely on obviously foot traffic. Now, through COVID, those centres have suffered due to the lack of obviously people wanting to go out and public transport, and as we've said, the popularity of sort of decentralized shopping malls closer to where people live, the residential suburbs, have done better. And I think that will accelerate, I think, through retail over the coming years. So I think developers have to be a bit more conscious of making the shopping environment more attractive. Obviously, people using their own cars are a bit more comfortable, but also the time that it takes to shop just for your groceries in the current climate, because obviously temperature checking, you're having to register. So I think there has been a move to more online shopping through these times, and I do think that will accelerate I think talking to the bigger retailers here, we're all caught a bit short with obviously the IT platforms for online retailing, obviously the logistics, and the market here is really quite small. But certainly talking to the bigger retailers, they are having been caught short a bit by this, are looking to invest in the infrastructure, which is expensive, both from the platforms and the logistics. And longer term, if they think the market here, as per your stats, is probably 1%, they do see that maybe moving up to 5%. So it is worth them putting the investment into IT platforms and the logistics. And if you think some of the bigger retailers have, say, 20 stores, and they think that's going to move from negligible amounts to 5%, that will affect how much physical property they would look to, take in the medium to long term. I think obviously if CBD retailing is going to change because of public transport and lifts and things like that, people changing, I think decentralized retail nodes will be stronger, and obviously those areas, say at the business parks at lower and at sort of Cali, closer to the suburbs, there might be further opportunity for expansion there. Okay, I think that's fine from Botswana. Hopefully that answers the question. Judy?
Thank you very much. Thank you very much, David. Just moving west a little bit to Nigeria, Topi. You have the demand, you have the numbers, you have the land mass, clearly a bounty of opportunities there. But what's the future of regional malls in light of the increase in development of neighborhood malls, Topi, in Nigeria?
Good morning, Judy. Good morning, everyone. The beauty of Nigeria is the fact that we've got a large population, and also we do not have enough shopping centers to cater to the population. At the moment, our shopping center space per square meter is the lowest within the region. And also, so what that means is that there's room and there's opportunity for growth. But at the moment, what we've noticed is that because of the state of the economy, there's been a slowdown in the development of regional malls. And more so with the devaluation of the Naira and how the Naira has swung with the impact of COVID and a little bit of unrest that we noticed in the past few months that happened within the country, that has slowed down the interest of developers in regional malls. But what we'll notice moving forward is the fact that regional malls on the short term will not play a major role, because at the moment, retailers, shoppers prefer to shop in neighborhood malls because it's close to home based on the conditions of the environment at the moment. But on the medium to the long term, regional malls are where to be. What that means for developers or investors would be that regional malls now have to offer more than what they used to before. They have to be more of a place where they provide connectivity, they provide entertainment, they provide experiences. It has to be experiential shopping for people that are going to them. People have to look forward to things, different things on a consistent, regular basis. If you look at the mall penetration in Nigeria, it started about 2004, and it's grown from that period of time to a space where we have over 300,000 square meters space of retail space within the country. But also the development of the regional malls have also followed the pattern of the flow of the growth of the economy. At the point in 2008, 2009, when there was the real estate crunch, and there was a slowdown in economic activities, impacted the growth of regional malls or development of malls in the Nigerian economy. Then also one of the things that we know that would happen moving forward is that regional malls would be most likely be developed in first year cities, examples of Lagos, Port Harcourt, Abuja, because those cities have the population and they have the middle class. Middle class will have the tendency to go into shopping centers because of how much of an impact or that increase in their taste. So we expect that regional malls would come up. At the moment, on the short term, But there might be a slowdown. Developers might stall on that. So that would mean that regional malls would be developed more so in the medium and the long term. Then also another thing that we expect that we would see on the short term is that for people that would invest in regional malls, they have to look at the risk of doing business in Nigeria, because we noticed that most regional malls before now didn't particularly take into cognizance insurance and design with how they develop their malls. So moving forward, design is going to play a major role in regional mall development. And also developers have to take cognizance of the fact that at any point that they're going into their developments within Nigeria, they have to put in place the impact of insurance on how that will in fact impact on their business. Thank you, Judy.
Thank you very much, Topi. Thank you for that elaborate answer. Bringing it closer to home, and this is a question for Mr. Mark Dutoy. The report reflects an 8%, I quote, the report reflects an 8% growth in rental rates in Kampala and an occupancy level of 71% in formal retail. Can you please elaborate on these figures, Mark?
Thank you, Judy, for throwing that tough question at me. Yes, it's a dichotomy if you look at it. How can you have 71% occupancy in formal retail, yet you're seeing a growth in your prime rentals? One has to go back a little bit in the history to understand and to evaluate and elaborate on those figures. The formalized shopping center industry has only really evolved in Kampala over the last 10 years. Taking into account, one, Kampala is quite a densified small city. Land costs are very high. You had a lot of developers go out and start developing within arterial routes into suburbia outside of the CBD. At that time of development, the developments were multi-level developments on very small footprints, with not a dearth of formalized retailers in the market. So take-up of space was relatively low and slow. And by the year 2015, 2016, it started to explode with a lot of international retailers entering the local market. What that did is rental levels were relatively low to start off with. And those leases started expiring and and renewals of those leases came at the end of 2019 and the early part of 2020. So you saw prime rental rates increase on prime areas within malls, and hence you're seeing that 8% growth, which has obviously been impacted now in the short term from the COVID and the fallout from the mechanisms and the measures to stop the human-to-human transmission. But you saw this growth in prime rentals, but you still haven't seen the growth across the board from the occupancy level. And the reason for that is the multi-storied malls on small footprints that are around. So generally your ground floor and your first floor of these malls are occupied and fully occupied. And when you get to your second, third, and fourth levels, in some instances, you find that's where the vacancy is set, and the vacancy is set there from inception. So obviously, the question around that is, how does one resolve that going forward? There's two issues to resolving that going forward. The first issue is for developers not to develop on spec, to develop around end user requirements, to engage the retailers, to understand what the retailers need, and to develop around the market and not from a speculative development and multi-storied development that you've seen historically in the past. The second issue is the same thing that we have all over the place throughout the continent, is to find the retailers, both the local and the international retailers, to take up the space and create more of a demand for the consumer to utilize in terms of product. And that's something that we've been working on, as you can hear from the different countries. Yes, there have been some failures and there has been some growth. But I think one of the biggest things, taking from what Tim has said earlier on, that we need to focus on is polishing the rough diamonds within our own market. We've been historically very reliant on South African retailers or the Middle Eastern retailers. We've been very reliant on franchise type operations to grow the retail sector within Africa. We need to now start refocusing on the rough diamonds that are within Africa and start polishing those up and formalizing them. Tilda mentioned in her research that there is a growth in the formalized retail, but the informal retail is still the majority of the market. And why is that the majority of the market? Because the retailers that captivate the consumer are still sitting in the informal market. So there's a huge amount of opportunity there, and there's a lot of work for us to do as landlords and property management companies to engage those retailers and grow them into the formal sector and bring with it the consumer from the informal sector into the formal sector.
Thank you.
Thanks, Judy.
Thank you very much, Mark. Taking it to our neighbor, Kenya, Ashmi. I would imagine that with the demise of ShopRite and Nakumatt from the Kenyan market, that opens up a lot of opportunities for other food retailers or supermarket retailers to come into that Nairobi Kenyan market. Would you say that this is the case?
Thanks, Judy. Yes, that's definitely the case in Kenya. What we've seen is supermarkets such as Naivas has now got 68 branches. In fact, they opened the latest branch yesterday in Thika. Chandarana, who've always been one of the small supermarkets, they've also managed to expand, and they've now got over 20 branches across Kenya. Then we've also got Carrefour, who managed to take up several of the Nakumatt sites. And the most recent they took up was the ShopRite space at City Mall Nyali in Mombasa. Quickmart are also on an expansion plan, and they have opened several convenience locations and strip mall locations. But in fact, they're actually now looking at opening up in shopping centers as well, and possibly taking up some of the bigger stores that have been either left behind by Nakumatt and possibly by other supermarkets. We have some other smaller supermarkets such as Magunas and Masai. They've taken up several locations outside Nairobi. They've managed to take some of the smaller locations, but they're slowly expanding outside of Nairobi. And then we also have Game, who have now managed to expand outside of Nairobi into Kisumu. They're also looking at other locations, and there is a lot of opportunities for supermarkets to open in Kenya. Thanks, Judy.
Excellent. Thank you very much for that, Ashmi. And we have some more questions in the chat room, and there's one specifically for Tim from Zambia. And the question is that my question for Zambia and is from Mr. Ismail El Mahdi, and he's saying in 2015 I left Zambia with 7 malls under construction, like Cosmopolitan. Is all this new shopping malls already added value to the Zambian market, or they affected in negative ways? Tim.
Thanks, Judy, and thanks, Ismail, for that question. I think, yeah, in 2015, obviously things were very different to where we are now. But some of these malls, if not most of them, were driven by retailers. So there has been this demand from the retailer to go into new areas around Zambia. And Zambia has really opened up outside of Lusaka, so up in the Copper Belt. I mean, you mentioned Cosmopolitan Mall. Now that specifically was serving the south side of Lusaka, where there were no formal retail centers. So with ShopRite going there, with Game going there, with Hungry Lion, and then the sort of tenancy mix that we know usually occupies malls, they wanted to be on that side of Lusaka. So I think the malls have added to the shopping demand. We are still very much driven as a shopping lifestyle in Zambia. I think Tilda in her research talked a little bit about online shopping, and it's very, very small here. It might be growing and was given a bit of a push by COVID, but really we like to go to the malls, we like to go shopping, we like to go and have something to eat or whatever it may be, as well as go to the shops or the bank and the services. The other thing is that some of these malls are very different in size. Some were neighborhood malls, 6,000 to 8,000 square meters, some like Cosmopolitan, which is much larger. So they are driven, they do add value, driven by the demand with new roads opening up. We've got the Lusaka decongestion plan. I think we know that we do have an oversupply. The occupancy that Tilda mentioned earlier for different malls around the region does exist. And trade is sometimes much harder this year, not only because of COVID, but macroeconomic issues as well. But I think all those malls have added. They were developed in line with the retailer demand and the anchor tenant demand. And I believe that even this year, we've had a couple of small centers open, one in the east side of town, which is about a 7,000 square meter mall on Leopards Hill, and one in Kabwata, which is much smaller, about 3,500 square meters. So I think the market is having to be forced to adapt, but I believe that they have been positive rather than negative overall, if you look at the long term.
Thank you very much for that, Tim. If I could send another one, a quick question to Ahad for Tanzania. Ahad, can you just give us an insight on retail in Dar es Salaam? It seems like quite a big market with a lot of potential there for retail. Can you just give us a very, very brief oversight of what's happening there?
Okay. Thank you, Judy. I hope you can hear me. Okay.
You're good. We can hear you. Yeah.
Okay, brilliant. For the time being, in terms of retail, we don't have had, because we did have a lockdown, therefore we did not have a negative impact on retail. Therefore, we have been operating shopping malls, very few of them. Most of the retail in Dar es Salaam has been done from informal, off the street. But one of the only operating shopping malls that we have, Limani City, has posted a quite healthy turnover of their operation. The other shopping centers, such as Mkuki House, Mall, and Quality Center, were impacted negatively even prior to the pandemic. So I would say for the time being, retail has been going on as it was prior to around 2018. And during this COVID period, we've noticed that supermarket premises have had, which have had vacated previous operators, have now been taken up by new supermarket retailers. And therefore that has had a positive impact on the shoppers, because at the end of the day, the shopping centers and the malls have anchors, and at the same time, it does assist with the footfall. Thank you, Judy.
That's excellent. Thank you very much, Ahad. There's a question from Nelly in the chat, from the chat room, and I think, Mark, I'm gonna field this to you if you don't mind. And it says, has there been an increase in tenants requesting for a shift to base plus turnover rentals? And what has been the reaction of the landlords and property managers?
Thanks, Judy. Thank you, Nelly. A very good question. If you look at the more mature markets, have always had turnover rental in. It's an international norm, and retailers can see the benefit of turnover rentals, because they understand that obviously if the landlord invests more in marketing and maintenance and that sort of thing, there's a better opportunity for them to trade, and everybody would prefer to pay 10% of their turnover as a rental than 20% of their turnover. So it's a win-win situation. Unfortunately, in less mature markets, retailers haven't really understood the turnover rental basis, and they've been very loath to move onto it because they've just seen it as a landlord profiteering off their business. And I think the more mature markets get, the more people understand it. What COVID has done is it's brought that relationship of landlord and tenant a lot closer together. You've had really two scenarios from a tenancy or a lease agreement perspective throughout the world. You've had the issue of the lockdowns, which has opened up either a force majeure issue or a frustration issue. Now, one must understand that force majeure is not a common law right. Force majeure is something that has to be contracted to. So where tenancy agreements have taken into account a force majeure clause, it has spelt out how the landlord and the tenant will deal with these various different lockdowns, etc. And in most cases, there was a certain amount of relief with an extension of the tenancy agreement thereafter. But where that didn't exist, it brings frustration into play, which is a common law right, where if somebody is unable to fulfill a contract because of a third party outside influence, which is beyond their control, it does leave it open to terminating, although frustration is very difficult to prove. So the majority of sensible landlords throughout the market came back to tenants and said, okay, we understand, we're all in this together, it's difficult. How do we work through this, and how do we find a solution where we both feel the pain and it's not one-sided? And reality is there is only one way to do that, and that is based on turnover rental, which is obviously a base of whatever the sales are. Certain percentages differ from genre of retail, and that generates and calculates the rental. It's probably the fairest way to do anything, because there's always a tug from both parties. Landlord wants more, tenant wants to pay less, etc. But because of that relationship coming together, you've seen the aspect now where tenants realize that landlords are not only there to profit off them, and it is a business partnership and a relationship. So the report itself will show, and the report will be released into the market later today, and all of you that have registered will receive a copy, is that there's probably 10% of the market has resisted in moving to turnover rentals. And the majority of the rest of the market now see the benefit that, you know what, in bad times, the landlords have come to the party for them. It's only due and just that in good times, they also need to come to the party, and everybody needs to benefit. Bottom line of it is a shopping center is a holistic partnership between retailers and landlords, and both are there to ensure that the property maximizes the ability to trade. And if that happens, both parties should maximize their profit.
Excellent. Thank you very much, Mark. My other panelists, does anybody want to supplement onto what Mark has said, or can I field another question? Anybody want to say anything else specific to your countries with regards to turnover rentals? No? Okay, Mark, I'm going to build another one to you if you don't mind. And this one is from Karen. And it says, hi, I'm from Africa Lifestyle, and we're operating Max stores in some countries in sub-Saharan Africa. My question is to the esteemed panel, is what happens to rentals when the currency devaluation is more than 25 to 30%, and therefore the local currency rentals go up, making the business unviable for retailers? I think you've touched a bit on that, but if you'd just like to answer specifically, thank you.
Sure. Karen, turnover rental. No, that's the short and sweet answer. Yes, look, Karen, it's a very difficult one, because we all know that this impacted Uganda in 2015, 2016, where the local currency devalued to the dollar in roughly 25%. Fortunately, it stabilized subsequently. It's an impact that has affected Zambia over the past year, with significant devaluation of the currency. There are two ways to look at it, and one needs to understand both parties' requirements. Generally, in the larger type of shopping centers, it's very difficult for landlords to develop those centers based on local currency finance requirements, simply because generally local currency bank finance is not available to that sort of scale. So banks need to syndicate those loans offshore, and that comes with a risk factor that is impacted by dollar-based rentals. So landlords, to get access to that finance, need to have dollar-based rentals. Now, if one looks at the development curve and one goes back, if you look throughout Africa, generally local currency leases, local currency finance runs anywhere from 10, 12% up to 20, 22%. Yet dollar-based finance is running at around about 5 to 7. So when you put that that input cost into the development itself, you will see that your flow-through rentals that is required to actually achieve the commencement of a development on a dollar-based rental are considerably low. An exercise we did in Uganda in 2017 showed that that flow-through rental on startup would be 66% less than on a shilling-based transaction. So when you start talking about a 25 to 30% devaluation in the currency, you still won't get to the inflation, the input cost and the flow-through rental that's required on a local currency-based lease. So that's from the developer side. Obviously, from the retailer side, the difficulty comes in. You start your business. You open up your business, you're seeing your profits, you're based on your outgoings on a dollar base, your incomings on a local based currency, and you learn to live with that sort of model. And then comes the 25, 30% depreciation. Your imported product cost goes up, and your outgoings in terms of rental, etc., go up, and it makes the business marginal. Now, that is where, once again, it's a relationship between landlord and tenant. It's easy for the landlord, if the finance of the property is paid off, to convert those to shilling or kwacha-based rentals or local currency rentals. They can then do that because they're no longer hamstrung by the finance requirements. And if they are not out of their finance process, then one has to have a look at a model that works for both. I mean, you've seen Zambia in this past year start doing adjustments and doing certain local currency leases that are hedged on CPI factors of inflation to try and help out retailers. Some have done it in the short term, some have changed to the long term. In Uganda, you saw the fact that the escalation rates on dollar-based rentals were very low, much lower than CPI. So once one took a 2 or 3 year view on the devaluation of the currency versus the conversion to shilling with a CPI escalation rate, it all panned out after 2 or 3 years. But the bottom line of it is, it helps if we move to turnover-based rentals, obviously taking into account that the landlord requires a base for the viability of the scheme. And that base can shift lower if the landlord sees the benefit in the turnover rentals, which also has been difficult historically in African markets, where it's mainly cash-based transactions. But with the different revenue authorities now implementing electronic recording of this, it takes that scenario out of play, where landlords are a lot more confident in seeing the real figures and the real business partnership. And it's no longer only the tenant seeing the business partnership when he's in trouble, but both parties seeing it when the times are good.
Thank you very much, Mark. I'm going to ask you to give, yes, sorry, Toby, carry on.
Yeah, can I add to what Marcus said?
Please do.
Okay, great, fantastic. Because the question attends to some of the things that have happened in Nigeria in terms of how the economy has flowed. So in 2016, when the Naira was devalued, what we saw was that most of the malls, the rents were paid in dollar, they were dollarized. So what we found out that tenants came up with a proposition that instead of paying our rents in dollars, why don't we do a mix of dollar and Naira, such that we have a hybrid rental process? So it kind of follows the terms of the base rent and the turnover rent. But in this case, it's just that cash is going out either way. The tenant pays up for the space as it goes. So how we have been able to ride that wave in Nigeria is that we've done or created a situation whereby the rent is loosely based on the dollar. A certain percentage of that is based on the dollar, so that it covers for the return on investment for the owners of the mall, such that they don't have vacancies, they don't have void period within their malls, and the tenants can pay their rent in naira as well too. So it kind of creates a partnership, like Mark said, where the tenants and the landlord have come to a situation where they create an hybrid rental arrangement where the rent is loosely based on the dollar to a certain percentage, and the other part of the rent is based on the naira. So this kind of helps the retailer stay in business, and it's not too much of an effect on the running cost, on the cost on the supply chain. So that's it.
Fantastic, thank you, Topi. There's another one. There seems to be quite a lot of interest and questions around turnover rentals. There's another one from Washera Minor. On the turnover rental, which measures are put in place to make sure that the tenants disclose an actual representation of their actual turnover? Anybody's free to take that?
Judy, oh, sorry, Ashmi, go ahead. Go ahead. Ladies first.
Thanks. Just to touch on from what Mark had said earlier, I mean, at the end of the day, there's got to be relationships between the tenant and the landlord. Some of the methods that we are using or have used is getting Z reports provided by the tenant on a monthly basis, and then that is followed by audited report from their auditors at the end of the year. And ideally, there shouldn't be a lot of difference between the two reports. In addition, we can also put systems in place at the point of sale. Obviously, this is a very expensive method of tracking sales. But I think long-term, it is one of the options that a landlord has for tracking tenant sales. Over to you, Tim.
Thanks, Ashmi.
Thanks, Ashmi. I was just going to, on two things really, on turnover and how you track it. We found that the more larger type of tenants have in their lease agreements that their accounts are audited or their management accounts, so they would be easier to track. I think what Ashmi's just talked about there for the medium to smaller tenants would make sense, but it is something that we're going through a learning curve of this year. And just quickly, just adding on, being in Zambia and having experienced a currency here that has devalued the most in the region this year, these questions about how do we deal with that issue. As Mark said, it's turnover. It's kwacha rentals. And then also some landlords have created a fixed rental sometimes for a certain period of time. In other words, our rate now today, for example, is around 21 kwacha to the US dollar. And as it's been falling, a landlord might have agreed with a tenant to fix that dollar rate at perhaps a lower rate of 21, closer to 15 or 18. But these are individual landlord cases. We are going through a learning curve. And I think what Tope was saying, what happened in Nigeria is interesting. We don't have that hybrid here in Zambia yet of a mixture of a guaranteed dollar income to cover return plus a share of kwacha rental. And that's something that could be interesting to look at here as well. Thanks, Judy.
Thank you, Tim. Panelists, I'm going to ask you to try and keep your answers rather brief because we're getting more questions coming in and we'd like to cover all of them. There's another one that's come in. How are the financiers adjusting to turnover rentals as they are an important third leg of the landlord-tenant relationship? Do you have insights on the current trends? Again, anybody is free to answer that one. Whoever's ready.
Judy, maybe I'll jump in there. Charles, it's very simple. It's not reinventing the wheel. The whole concept of base rental or turnover rental, whichever is the higher, comes out of the requirement of the finances. Anybody to finance a bankable project needs to see a return and a guaranteed return. So the history of turnover rentals has evolved on that basis, that obviously a low base rental, and that base rental is in reality what needs to cover the finance arrangement, or turnover rental, whichever's the greater. The industry has evolved that over 3-4 decades now, because that is a requirement of the financier. It becomes a very difficult aspect where there is only a turnover rental basis, because there's no guaranteed return. And that is why you will see those sort of calculations coming into either distressed shopping centers or the likes of casino type developments or airports, where the base, the actual product that is on show is not the shopping center, the retail, or the entertainment around it. They are there to add value to an airport, which generates its income from an airport, or from a casino, which generates its income from a casino. So in those establishments, you see purely turnover rental base agreements, because they're an added value to the major product. But in shopping centers, it is difficult, hence the aspect of having the base rental there.
Thank you very much, Mark. I think there's quite a few on turnover rental. There's another one. How do you determine the adequate level of turnover rental?
Okay. It's I'm going to jump in there, Judy, if none of my colleagues want to climb in. It's the billion-dollar question. No, it's actually a very simple aspect. There is no basis of turnover rental. One has to have a look at the genre of the product, and I'll use a very simplified example. If you're dealing with a jeweler who is a mass distributor, they're basically buying in pre-made jewelry and they are then on selling it. One has to look at what their profit margins are, and one bases the turnover rental based on that. So the turnover rental generally for that genre of trade is 10%. But one can't say that all jewelry stores operate at 10% of turnover rental, because you might have a manufacturing jeweler who now does a setting and a stone for a specific client at $100,000, and their profit margin on that might only be $2,000 or $3,000 because it's only an hour or two's work. So one has to dig down into each type of trade and have a look. Generally, you've got fashion retailers that are operating at some 250 or 300% margin. You also have discount fashion retailers that are doing loss-leading product at hardly any margin. So one has to have a look, and that's the science of turnover rental, is have a look at the nature of the retailer, have a look at the nature of their profit margin, and then depict a turnover rental from there.
Thank you very much, Mark. Ashmi, there's a quick one for you from Abraham Munene, and he says, pre-COVID, Nairobi had a number of international brands looking for a new home. Is this pushed by the brands coming back, and how strong is the demand?
Okay. Thanks, Abraham. International retailers, there was, yes, you're right, there was a massive push by international retailers pre-COVID to come into Kenya. And I believe this is still the case. There are brands who are still looking for space. We get inquiries on a continuous basis for different brands who want to come in. Maybe the pace that they will come in might be slower than what they initially planned, but they're definitely still looking at coming into Kenya.
Thank you very much. Mark, there's one for you. It's quite long. I'll just try and break it up into bits. It's from Mr. or Miss Kaiwa, and it says, hi, the central bank in Uganda has indicated the country's fiscal space narrowed to about 3%. And with this, warned of an increase in the default rate. The bank has advised banks to tighten their lending appetite. Also, there seems to be an increase in online shopping. Since the COVID-19 pandemic broke, as well as more people preferring to work from home, instead of renting a workspace to cut expenditure, are these factors likely to affect development of retail infrastructure? And the last part of the question is, what changes are we likely to see as the Kampala retail sector recovers from the COVID-19 impact?
Okay. In the report, we actually deal with online retail, which is obviously the flavor of the month at the moment. And it's a concern coming out of specifically Western media. And it's very topical today on the back of Debenham's demise, which is tragic for the European retail industry, which has seen a flagship group, which has been in existence for over 200 years, fault, and a lot of that is blamed on online retail. But we really need to look at the data and have a look. In America, you're running probably about 16, 17% of total retail sales are on online. In China, for instance, it's just above 20%. And in Africa, it's below 2%. Now, what are the factors behind that? You must realize also in these countries such as America, or even South Africa for that aspect, Dubai, the Middle East, you have a huge amount of retail in excess of a square meter per person. So the formalized bricks and mortar retail industry is very prevalent, and there's a very big mall culture. You've then seen in countries in Africa, we're talking about Botswana at the highest at 1.3, and then the rest at negligible at under 0.5. We don't have a formalized retail industry, and we don't have anywhere near saturation throughout Africa. But the same can be said for the online aspect. Tilda spoke earlier about the capital involved in online. She's also, the report also intimates to the logistics in getting online into Africa, where you don't have street names or you don't have street numbers. So logistically, it's very difficult. What has definitely happened in the market, and during COVID, you've seen 60 to 80% increase in online sales. Interestingly enough, though, the moment the lockdowns opened up in various countries, you've seen online sales return back to pre-COVID levels. What we can assume out of that, and I think this COVID has taught the lesson, because if there was anything to catapult online sales into the stratosphere and finish bricks and mortar retail, it was COVID, and it hasn't happened. There is definitely an aspect that bricks and mortar shopping, by the very nature of human beings wanting to be social, wanting to touch and feel, wanting to go out and about, will always be there. And it will always be the majority share, which is then backed up by 15 to 20% of total sales being online, from the convenience factor and also the aspect of not being able to get product from various regions. You could have shopping centers in, if you look at America, you have stores in New York that aren't in Minneapolis. How do people get that product? The only way, they can't travel 3,500 kilometers, they purchase it online. In Africa itself, we have a long way to go to hit saturation of bricks and mortar and even have saturation of online. Online is impacted in mature markets where they had a total sustainability on bricks and mortar. Online has come in and has taken 15 to 20% of that away, of the retail sales in the shopping centers, which is going to impact 15 to 20% on the shopping centers. In Africa, we've got a very, very long way to go. You can see the amount of work that has been done in South Africa on spending on the various different online portals and bases, and they've got to a maximum of 1.8% of total retail sales online. People still enjoy bricks and mortar. People will forever and a day, and there will only be a certain attrition that will move to online. I hope that answers the question. So from sorry, just to add to the last part of the question, from a development aspect, you are still going to see a huge amount of online development, but in Africa, you're still going to see a huge amount of shopping center development, because your consumer is transitioning in some markets slowly, in other markets dramatically and very quickly, from informal to formal type of retail. And COVID is going to impact on that because people are looking for safer, more socially distanced, more clean environment to ensure their own personal safety going forward, which aids and abets the shopping centers that are currently developed and in development.
Thank you very much, Mr. Jishoy. There's a very interesting question here, and I'll take to a panelist from Sudhir Maharaj. And he says, does a landlord have any obligation to protect the interests of an existing tenant in terms of determining whether to introduce a competing brand within a mall? The interest of the landlord in needing to let out a space that has been empty for a long time is understandable. Should there be any compensation to the affected tenant for this unexpected loss in turnover within the mall? Anybody can take that. If there's nobody ready, Mark, it might have come to you.
Hello. So,
Turkey on.
Yeah. So typically, before you go into a mall, landlords are looking at the composition of the mall, the tenant mix, how well that will play out in them realizing returns on investment. So from our own experience, what we found out is that if typically a landlord wants to have as a food court and he's got 2 tenants in there already, and there's an opportunity for another tenant to come into the space for a food court as well, too, or another space different from a food court. But because of the fact that the arrangement ab initio states that there's just going to be 2 food retailers within the mall, typically what they would usually do is excuse the third tenant or prospective tenant that's looking to come into the mall. Another quick example is that I've noticed within the market, within the retail space, is for tenants that sell fragrances within a mall, there's said to be a certain number of space allocated to them. So it's understandable that the landlord wants to make income, but some of the tenancy agreements that the landlord and the tenants come together to place an obligation on the landlord to protect the investment of the retailer as well too, because you don't want to have a case where there's oversaturation of a particular type of service within a mall. So what that even does for the landlord is that it leaves them to the risk pertaining to that type of business. So they are open to a lot of uncertainties when it comes to that particular type of business. So the obligation, there's some sort of obligation that falls on the landlord to ensure that certain businesses, if they max out at a particular level, they don't welcome new tenants, even if there's space for them to come on the market. And that's been very true with the COVID-19, and also be very true with the fact that, for example, a country that is dependent on oil like Nigeria, if your tenant mix is not particularly rich and robust, what that leaves you to is that it leads you to the dwindle and the swindle of our economic policies.
If I can add on to what Tope has just said, there's 2 factors that we need to have a look at. The first factor is the landlord is also in business. The landlord is not a charity. So the landlord is not going to willfully place another product in a shopping center that impacts negatively on an existing product and puts it out of business, because then the landlord is going to be out of business from 2 specific shops. So that is the one issue. The second issue is, does the landlord have an obligation? This has been tried in countries. Have a look at South Africa, where there were exclusivity clauses, which has now been proven illegal. And it due to various anti-competition acts. So it is a difficult one. One has to have a look at the genre. If hypothetically, if one has KFC in your shopping center, are you going to put another chicken, Southern fried chicken type of tenant in? It depends on the market dynamics and the market demand of a shopping center. And there might be the ability for 2, there might be the ability for 3, or there might not be that ability. If it's fashion, what do you do? Well, we all know fashion is comparable shopping. And the more fashion you have in the center, the better they all trade. So yes, the landlord will duplicate it. If you have a look at, for instance, the fight back in South Africa many years ago, and I see Brett Exner from Woolworths was online, when Woolworths rolled out its food store, a lot of the supermarket retailers didn't want them in the same shopping centers because they saw them as a competitive threat. Whereas today, a lot of the supermarket retailers want the Woolworths food in a shopping center with them because they've seen the benefit that the variety of product does for their store in bringing in a bigger market, and it generates and benefits for both of them. So bottom line of it is one has to look at the market and one has to be realistic, and the majority of landlords are. They're not there to put anybody out of business, but they are there to grow their primary market.
Thank you very much, Mark. I think that's all the questions that we have for now. Shall I hand over to you yourself, Matilda, just to do the wrap up?
Yes, thank you very much, Judy. And ladies and gentlemen, thank you for joining us today. I hope it has been insightful. We're getting some lovely comments on the chat. Thank you very much. The report will be out, the full report will be out today. It's very special thanks to Tilda for all the hard work she's put and all the research that she's done into this, and for her fantastic overview in the presentation. Knight Frank, we're always here for you, and we will keep you posted, and look out in your inboxes later today for the report.
Thank you very much, Mark. Thank you very much, Tilda. That was an excellent presentation. Panelists, thank you very, very much for your insights, the country-specific insights. That was really awesome. And to all our participants who have taken the time out to be with us this afternoon, thank you very, very much indeed. We will make sure that we get the report out to you as soon as we possibly can. And if you don't receive it, then please visit our website. It should